This is Caterpillar Inc., ticker CAT, a $382 billion industrial, trading at $830 a share, a 44 times trailing PE, on the books in Delaware. Every number in this deck traces back to SEC Edgar. Here's why it matters right now. On August 4th, Caterpillar reported the strongest quarter in its history, $20.5 billion in revenue, up 24%, the first time it's ever crossed $20 billion in a single quarter. Earnings beat by nearly 31%, and backlog jumped 92% to $72 billion. Shares jumped almost 9% in pre-market trading. The question is whether that reaction is justified. To answer that, start with the business. 4 segments: construction industries, resource industries, energy and transportation, and financial products, CAT's captive lender. Machine sales build a global installed base. That base drives a recurring parts and service annuity, while CAT Financial earns spread income financing the same machines. It's a flywheel, not just a hardware maker. Margins tell the real story. Operating margin has climbed from 16.5% for the trailing year to 17.3% in Q2 of last year to 20.9% this quarter. Net margin sits at 13%. Return on assets at 9.3%. Solid numbers for an asset-heavy industrial. On the balance sheet, $95.5 billion in total assets, $30.7 billion in long-term debt against just $4 billion in cash. That's not alarming once you remember CAT Financial funds its lease and loan book with debt by design. It's a finance company wrapped inside a manufacturer. On valuation, the 44 times trailing PE looks rich, but it's a stale number chasing a price that already moved. The forward multiple, 28.4 times, is only a modest premium to the industry's 26.6, and that premium is earned. CAT is up almost 97% over the past year, more than double the S&P 500 and every named peer. What could extend this run? Data center power demand, a $72 billion backlog, and record low loan delinquencies. What could end it? Today's margin strength assumes it holds. Tariff exposure is pressuring guidance toward the midpoint, and after a 97% run, a lot of good news may already be priced in. The quarter itself, $20.5 billion in revenue, $8.17 in adjusted earnings per share against a $6.25 estimate. Margin up to 20.9%, backlog up 92%. The driver behind it, surging demand for power generation tied to data centers and AI, strong enough that Caterpillar restarted a discontinued engine platform to keep up. Here's the deeper shift. Caterpillar is quietly becoming a power company. Demand for engines and turbines powering data centers doesn't move with the construction cycle. It's structural, not cyclical. Restarting production capacity, rather than just raising prices, is the clearest signal management believes this demand is durable. 5 habits to take away. Use forward PE, not trailing. Watch backlog as your real forward indicator. Separate industrial debt from finance arm debt. Track the margin trend, not a single spike. And watch whether energy and transportation keeps outgrowing construction, because that changes what kind of company you're actually valuing. Every figure here traces back to SEC Edgar, Caterpillar's own investor relations site, and the Q2 2026 8K filing. Verify it yourself before acting on any of it. This deck is educational, not investment advice. It's a snapshot as of August 2026. Treat it as a starting point for your own research, not a final answer. Thank you.